Okay, we're going to finish up Chapter 18, or actually refresh it now that you've all come back from spring break. It'll be a nice little refresher. And I'll do a whole series of exercises and one large problem out of the back of the book. So let's start with exercise number 3 on page 45. In this one, at the end of 2013, its first year of operations, Slater Company reported a book value for its depreciable assets of $40,000 for financial reporting purposes and $33,000 for income tax purposes. So what that is telling you, that under MAKERS, the modified accelerated cost recovery system that the IRS uses, the depreciation expense is higher for tax purposes than it was for straight line or whatever they were using for financial U.S. GAAP purposes. Slater earned taxable income of $97,000. That's taxable, not financial income. And then it's subject to a 30% tax rate. No changes to those rates have been enacted for future years, and this depreciation was the only temporary difference between taxable and financial income. So in each case, when we're doing these problems, so 2013, December 31st, what we're trying to reach is income tax expense. Bless you. To do that, we're always going to start with income taxes payable. And then we'll add or subtract timing differences in order to compute the expense. All right? So income taxes payable is always going to be taxable income, which the problem in this particular set of data gave us taxable income, times the tax rate. So in this case, we have $97,000 times the 30% tax rate. So that's income taxes payable of $29,100. All right? Then we need to calculate any deferred tax assets or tax liabilities that are generated for each and every temporary difference. And as we get into the more complex problems, you'll see that you separately calculate these deferred tax liabilities and assets depending upon the temporary difference that is being addressed. All right? In this case, there's only one. We're deducting more depreciation under IRS purposes than we are under U.S. GAAP. So if we're taking more deductions, that's creating a liability that we'll have to pay sometime in the future, because eventually it's going to turn around. Does that make sense? Because you're only going to ever depreciate the difference between the original cost and the salvage value, the residual value. The depreciable base is all that's available to deduct for depreciation purposes, both tax and financial. So if we're taking more for tax now, we'll eventually be taking less than financial, assuming straight line in this case, less than financial at some point in the future, in which case we'll pay more taxable income on those years. And I've got an example that shows the complete, that's the next one I'm going to do, the complete series all the way through the life of a 5-year asset. All right? So this is going to generate a deferred tax liability. It's a liability because we've got more tax deductions right now than we do financial. So we're just going to take the difference in the book value, the $40,000 versus the $33,000. That's a $7,000 difference. And multiply it by the tax rate of 30%. That's $2,100. Add those two numbers together and you get $31,200. $31,200 as your total income tax expense. That's all there is to it. Does everyone understand this so far? Starting with a very simple. Raise this up a little bit. Because we're going to get more and more complex here in a second. All right? So let's move on to the next page and do problem number 9. And this shows the entire cycle of the temporary difference. So for this one, I'm going to write up here on the board, let's see, what does this start with? 2012. So 2012, 2013, 2014, 2015, and I'll try to squeeze in. I should be able to. So there's a 5-year life of an asset that is generating a temporary difference. All right? And it's through depreciation. So in this one, Tanner Corporation begins operations in 2012. And it's important when they're telling us it's the first year of operation because that tells you there wasn't any deferred tax liabilities in the prior year that we have to account for. So it began operations in 2012, reports the following amounts of pre-tax, financial income, and taxable income. So it's telling you the difference between U.S. GAAP and IRS purposes in each of the 5 years. They only have one temporary difference, and it originates in reverses occurring in any single year. And it's subject to a 30% tax rate for all 5 years. So in 2012, they had financial income of $70,000, taxable income of $50,000. Same kind of scenario as what we just did for the single year. All right? There's a $20,000 difference between the two. As always, we're going to start with taxable income in order to calculate the income taxes payable. So income taxes payable for the first year is the $50,000 times 30% or $15,000. There's a difference between financial and taxable of $20,000. If you take the $20,000 times the 30%, you get a deferred tax liability of $6,000. Add those two together, and your income tax expense for 2012 is $21,000.
So the 6,000, it was what, 70,000 minus 50 times 30?
Correct.
What was the first one?
We had $70,000 for financial purposes and $50,000 for tax purposes. That's a difference, a delta of $20,000 times the 30% tax rate. The income tax payable is the $50,000 of taxable income that it gave us in the problem. All right? Everybody with me so far? Yes? Is anybody not? Before I move on. So the second year, it tells us that taxable income in that second column there is now $75,000. 75,000 times 30% is 22,500. Financial income in this second year, 2013, is $85,000, a difference of $10,000. $10,000 times 30% is $3,000. Add the two together and you get 25,500 for 2013. In the third year, 2014, financial income and taxable income are both $90,000. So at this point, the depreciation that we take for IRS purposes is equal to the depreciation that we took for financial US GAAP purposes. So we multiply taxable income times the tax rate to come up with payable, and we get 27,000, which is also the income tax expense. All right? Now it turns around on us. Now for 2015, starting with income taxes payable, income taxable income is $92,000 times the 30% gives us a payable of $27,600. However, financial income is $82,000. It's now lower because of the accelerated depreciation under makers. They now, in the latter years, in year 4 and 5 of this 5-year asset, it's going to be lower than straight line depreciation. So at that point, we're going to debit the deferred tax liability. So that's $3,000, leaving us with $24,600 as an expense.
How did you get that $3,000?
The difference between taxable and financial is $10,000 times the 30%. All right, does everyone see how this is working? So what's going to happen in the final year? The final year, our taxable income is $113,000 for $33,900 in income taxes payable. Financial income is $93,000, a difference of $20,000. And so that's a $6,000 debit to the deferred tax liability, which reduces that account to zero, leaving us with $27,900 in income tax expense. Okay? So that's how this all works. Let's do another one. Number 10 on the bottom of page 46. We're back to a single year. Everybody get all this already before I erase it? On this one, Vickers Company reports taxable income of $4,500 for 2013. Taxable income, once again, is what the problem is starting with. They have two temporary differences between pre-tax financial income and taxable income. The first difference is expected to result in taxable amounts totaling $2,470 in future years. So that's creating a liability, because you're going to pay the taxes sometime in the future, just like it could be accelerated depreciation, it could be a number of things. The second difference is expected to result in deductible amounts totaling $1,360 in future years. They have a deferred tax asset on the books at the beginning of the year of $372 and a deferred tax liability of $690. The current tax rate is 30%. All right? So, in each of these cases, once again, we always start with income tax payable. So the income taxes payable is going to be the $4,500 times the 30% tax rate, which is going to give us $1,350. We have a deferred tax liability and a deferred tax asset in this case, each of which has an existing balance. All right? So starting with the liability, we're expecting a $2,470 liability sometime in the future. So we're going to pay more taxes on $2,470 sometime in the future. Times 30%. But we're then going to deduct the balance in the liability account, the $690. Because what it's giving us now is all of the future difference between financial and tax purposes. All right? So multiply that out and subtract it, and we're going to wind up with a balance of 51. So $2,470 times 30% is $741. All right, so this is 741. Minus the 690 gives us a current adjustment to the deferred tax liability of $51. The deferred tax asset is going to result in taxable income of $1,360 times the 30%. Minus 372. That's going to result in a difference of $36. So this equals $408. minus the 372, we get 36. If we take the 1,350, we add the 51, we get 1,401, and subtract the 36, we're left with 1,365 as income tax expense. Everybody good? You all look so sad. Wish you were still on break. Can't help you there. I do too. Except for the swim team who was here the whole break. Huh? Fun stuff. Practicing every morning. Even on Saturdays. I was here for the Irish Festival Saturday morning, and I was before dawn, and all of a sudden I heard all this fury, and because we were in that classroom is where we were counting all the cash. So they had us locked into the classroom, and then you guys came in. All right, let's do problem number 13, because this is now going to talk about the difference between temporary and permanent differences. So exercise number 13. And it's on next page, 47. All right, and this one, assume the following facts for Muntz Company for 2013. They reported pre-tax financial income of $800,000. So here's a difference from what we've been doing before. In every exercise that we've done thus far, they gave us what taxable income was. So now we're starting with financial income, and we're going to have to compute taxable income. So in addition, they reported the following differences between pre-tax financial and taxable income. Interest income of $80,000 was received during 2013 from an investment in municipal bonds. This income is exempt for tax purposes. Rental income of $40,000 was collected in 2012, and it was included for tax purposes during that year. Because rental income, if you're going to pre-charge your lessee for income, then you have to report it as collected for tax purposes. Whereas for financial purposes, we know that creates a liability, a customer deposit, and it's only financial income revenue when it's earned. Okay? For financial statement purposes, it will be reported as earned equally in 2013 and 14. And then an asset with a 5-year life was purchased in 2013. Straight line depreciation for book purposes was $40,000, but for makers, it's going to be $100,000. And then lastly, warranty expense of $20,000 was recognized in 2013 for the income statement, while only $5,000 was recognized for tax purposes. So for tax purposes, for U.S. GAAP, we have to estimate warranty on products that we offer warranties for. But for tax purposes, we're only allowed to actually deduct warranties when we actually perform the warranties. So when we actually send a technician out to our customers, or we take a product in and repair it or replace it, okay? So for tax purposes, it's only as actually spent, right? You're seeing a trend here. The IRS likes the cash basis of, so it's not strictly cash basis, but they do really like that. All right, so off to the side here, I'm going to calculate what taxable income. So we have financial, of 800,000. We have non-taxed non-taxable forever interest. So that's the 80,000 of municipal bonds that's included in the 800,000 pre-tax financial income, but we're never going to pay taxes on it. So that's a permanent difference here. All right? Then we had the rental income that we already paid taxes on it. We paid taxes on it last year when we received the entire 40,000. Only now, for financial purposes, we're including in this 800,000, 20,000 of earned rental revenue. All right? So we need to remove 20,000 for that. Then we've got the depreciation. That's an additional taxable deduction over the straight line depreciation of 60,000. And then the last, we have a non-deductible warranty. And that's going to add to taxable income because we only can deduct 5,000 where we actually accrued 20,000 in expense for US GAAP purposes. So does everyone see where I got these numbers? No. The 60,000 is the difference between the 100,000 for makers and the 40,000 for straight line. That's the delta, the difference between the two. Yes, sir.
Why is the 15? Shouldn't that be a minus? Like, only going to take away?
No, because what was included in the 800,000 is a $20,000 warranty expense.
Oh, okay.
All right, we can only deduct 5 of it, so we need to add back in order to compute taxable income. So taxable income is equal to 655,000. If we multiply that by our 30% tax rate, I'm sorry, 40% tax rate, they changed up on me. We'll get a income taxes payable of $262. Oh my goodness. Man, that hurt. Tried to minimize it because I was sneezing right into the microphone. Okay, so that's going to be income taxes payable of $262. Wow, gave me a headache. Whew. All right, the $80,000 permanent difference does not create a deferred tax asset or a liability. So there is no journal entry needed for the $80,000 because that's never going to be taxed. All right? So on the non-taxed rent, what happened was last year when we took that $40,000 that we collected in rent in advance and we paid taxes on it, we created a deferred tax asset for that rent. Now we're going to be reducing that, so we need to credit now a deferred tax asset on rental revenue. So 20,000 times the 40% is $8,000. Then the depreciation is going to create a deferred tax liability. The 60,000 times 40% is 24,000. And that's a credit because we're taking more depreciation for tax now, but eventually we're going to have to pay it back. Okay? Everybody with me so far? You got a question?
Yeah, where do you get the 20%?
The 60,000 for depreciation, the difference, times 40%. All of this is 40% tax rate. So this 40% is tax rate. All right? And that leaves us the warranty. So the warranty is non-deductible, assuming that our estimate is right. Eventually, we're going to be able to deduct it sometime in the future. If, in fact, our current year's sales is going to generate $20,000 worth of warranty eventually, then we'll have those deductions in the future. So that's creating a deferred tax asset for warranty. If you take 40% of that, you'll get a $6,000 debit. Add all that up. 262 plus 8 is 70. 94 minus the 6 is 288. Is the income tax expense. See, it's like a little puzzle. Aren't these fun? Just going to hold off on that. All right, let's do a big complex problem. Very similar to, well, sort of similar to what you have to do for your homework. Problem number 14 on page 55. And then I'm going to go back and do a couple of examples on carry forwards and carrybacks. But let's go ahead and finish out the deferred temporary difference stuff. Let's see here. Yeah. I'm going to go ahead and just erase all this. Actually, I need to move that down a little bit. Okay. All right, so problem number 14 on page 55. Okay. At the beginning of 2013, Norris Company, I didn't write it, it's just a random choice of problems. Norris Company had a deferred tax liability of $6,400 because of the use of maker's depreciation for income tax purposes. So they had an existing liability out there for the accelerated depreciation under makers. They use units of production depreciation for financial reporting. The income tax rate is 30% for 2012 and 13, which was last year and the current year. But next year, the Congress has enacted an increase to a 40% tax rate. So the accounting records show a pre-tax items of financial income Income from continuing operations, $120,000, and it gives you the revenues and expenses. Because one of the things it asks you to do is to create a full income statement and a statement of retained earnings, which I'm not going to do on the board. Then it has a loss from operations of discontinued Division F of $10,000. It has a prior period adjustment of $15,000 due to an error that understated revenue in the prior year. All of these items are taxable. Financial depreciation for 2013 now exceeds tax depreciation by $5,000. So that's going to whittle away a little bit of that $6,400. And then it goes on to tell you what the retained earnings balance is and what dividends they paid so that you could do the statement of retained earnings. All right? And I'll put a note out. You don't have to do that for your homework either. I'm just looking for the calculation for income tax expense and what the journal entry is. So that's all I'm needing you to do for the homework. All right, so starting once again with financial income. All right. So income from continuing operations is $120,000. We have a gain on Division F of $23,000. We have a prior period adjustment for the underreported revenue from last year of $18,000. We have a loss, operating loss on Division F of $10,000. Am I missing something here? I got something awry. 120, gain of 23. And, oh, the extraordinary loss. This is the extraordinary loss. This is not the prior period yet. An extraordinary loss. And then we have the $10,000 on loss from operations, and then the prior period adjustment is $15,000. Okay. And that's a plus because it's underreported. And then now our depreciation is $5,000. And that's a plus because the depreciation now for financial purposes is higher than for tax purposes. So we need to add back the depreciation difference. If you add all that up, you get $135,000 in taxable income. The rate is 30%, which gives us a payable of $40,500. So income taxes payable equals a credit of $40,500. Now, each and every item on here needs to be a journal entry. Because if you recall from your multi-step income statement, everything below financial pre-tax income or income from continuing operations, is net of taxes. You remember all that? Okay. So the gain on Division F, which is a credit balance because it's a gain on all the revenues minus expenses, is going to generate a debit, gain on disposal of Division F. So 30% of the $23,000 is $6,900. The extraordinary loss is a debit balance because it's a loss, so we're going to credit the extraordinary loss. For the 18,000 times 30%, or 5,400. The operating loss from the Division F has a debit balance associated with the loss. So we're going to credit the tax benefit for loss from operations of discontinued Division F. So 30% of 10,000 is $3,000. The prior period adjustment is going to require, the prior period adjustment is a credit balance because it's understated revenue, so there's higher revenue now. So we're going to debit the tax effect, retained earnings, %30 of the 15,000, or 4,500. And that leaves us the depreciation. Now here's where we're going to have a slight alteration to it. The depreciation is for future years. Because it's now turned around, the depreciation is going to be times the future tax rate of 40%. So we have a $5,000, and we're going to be now lowering the deferred tax liability. On depreciation. So 40% of the $5,000 is $2,000. If you add up all the credits, subtract all the debits, you get a difference of $35,500. And that is your income tax expense. Yes? Everybody's going to just whiz through the homework. No problem. Just go do it this afternoon before the game. Get it out of the way. Don't leave it till Sunday. Enjoy your weekend. It's a crappy day out there today. It'll be nice on Sunday. Okay? All right, let's go back and do two more, and then we'll call it a day for this chapter. Let's do what the accounting entries are required for operating loss carrybacks and carry forwards. All right. We're going to do exercise 14 and 16. So back to exercise. And these are both on page 48. All right, at the end of 2013, Keel Company reports a pre-tax operating loss of $80,000 for both financial and income tax purposes. Prior to 2013, Keel had been successful and had reported and paid taxes on the following pre-tax financial and taxable income. So in each case, there is no temporary or permanent differences between U.S. GAAP and IRS purposes. In 2010, they had $37,000 of income, 2011, $50,000, 2012, $54,000. They were subject to a 20% tax rate in 2010, 25 and 11 and 30 in 2012. So, what we need to calculate is the effect of the carryback. They have elected to carry it back. And the carryback is for 2 years. You can take a current year operating loss and offset taxable income for a maximum of 2 years in the past, or, which we'll see in the next problem, you can elect to carry it forward up to 20 years. All right? So, 2011 and 2012. And you must carry all that you can back to the farthest year of the 2 years. You don't get to cherry pick. Because otherwise you would, because what's happened here? In 2011, you only paid 25% tax rate, whereas in 2012, you had a 30% tax rate. So if it was left up to the taxpayer, you would offset the years with the highest taxes. They don't give you that. The IRS mandates that you must take it back. So in 2011, we have $50,000 worth of taxable income at a 25% tax rate for a potential refund of $12,500. In total, we have an $80,000 loss. So that leaves us for 2012 to partially offset the taxable income that we had from that year, $30,000 left that we paid a 30% tax rate on for a total of $9,000. That, because that's the statutory tax rate for that year. It tells us in 2012 that the tax rate was 30%. See that? It's the last sentence in that problem.
Wouldn't it be 54?
No, because 54 is the total amount of income that we made that year, but we only have $30,000 worth of loss left to offset. Because in total, we lost $80,000 in 2014. This is the 2013 loss. All right, everybody with me? So on 2013, December 31st, we have a debit to income tax refund. Receivable. Of $21,500. The credit for the income statement is income tax benefit from operating loss carryback. for the same 21,500. Now the income statement presentation for this, you would have pre-tax operating loss, of that 80,000. And then you would subtract less the income tax benefit from of that 21,500, and that would give you a net loss for the income statement of only 58,500. That's a carry back. So how does it differ when it's a carry forward? Look at number 16 on the same page. On this one, Baxter Company began operations in 2009 and was profitable through 2012, during which time the tax rate was 30%. At the end of 2013, they reported a pre-tax operating loss of $135,000. Once again, both financial and taxable are the same. Because the tax rate was increased to 40% for 2013 and beyond, they elected to forgo any carryback of the operating loss. And then in 2014, they had a pre-tax operating income of $150,000. So let's do the 2013 entry and the 2014 entry. So what this entry is we're going to, rather than creating a receivable, we're now going to have a deferred tax asset. And then we'll get income tax benefit from operating loss carry forward. And what that is the $135,000 loss times the 40% current and future tax rate. So that's $54,000. So we would once again have a pre-tax operating loss, only this time we've got $135,000. We've got a benefit of 54 now, and that's because of the carry forward, not the carry back. Which gives us a net loss of 81,000. With me so far? So in 2014, we now made $150,000. We have the $135,000 loss that we get to offset that taxable income with. So now we have a $15,000 taxable income times 40%, or $6,000 payable. So income taxes payable is $6,000. We're going to use up all of the deferred tax asset. Of $54,000, and that's going to give us an income tax expense. This is 14. Of $60,000.